What if I told you that a coffee shop holds more cash deposits than 85% of all actual banks in the United States? It sounds impossible, but look at the numbers. As of recent reports, customers have loaded over $1.6 billion onto Starbucks cards. That is more money than the total deposits held by many regional banks across the country. Stop thinking of them as a cafe. You need to start seeing the truth. Starbucks is actually an unregulated Fintech company that uses coffee as a front. They have built a financial ecosystem that rivals major institutions, but with one massive advantage. They don't have to follow the rules of banking. To understand how this happened, we have to look at the scale. Starbucks didn't just want to sell you a cup of coffee. They wanted to become a part of your daily routine. But as they grew from a local roaster to a global empire, they realized that transaction fees from credit cards were eating into their profits. They needed a way to bypass the system. Enter the Starbucks app. Launched at the perfect time, it wasn't marketed as a financial tool. It was a game. Gamification is the key here. They convinced millions of people to digitize their cash in exchange for stars and rewards. It shifted the psychology from spending money to earning points. The result? A massive pool of money known as the float. This is the cash sitting in the Starbucks ecosystem that hasn't been spent yet. It's billions of dollars that customers have already paid, but no coffee has been brewed for it yet. And this mountain of money is just sitting there waiting. At its peak, the Starbucks mobile app processed more mobile payments than Apple Pay or Google Pay. They became a dominant force in the payments industry almost by accident. But here is the critical difference. When you put money in a real bank, that money is a liability for them. For Starbucks, it's something much more powerful. Here is the genius mechanism. When you load $20 onto your app, you are effectively loaning Starbucks $20. But unlike a bank that has to pay you interest on your deposit, Starbucks pays you 0% interest. You are giving a multinational corporation an interest-free loan, and you are happy to do it. If a real bank takes your money, they are handcuffed by regulations. They must keep a certain amount of cash in reserve to ensure you can withdraw it. They can't just take your deposits and go bet on the stock market or build new offices immediately. The law prevents them from being reckless. But Starbucks is not a bank. They are a retailer. This means they bypass those strict banking regulations. They can take that $1.6 billion of float and use it immediately. They don't have to keep it locked away. This gives them a level of financial freedom that a traditional bank could only dream of. Think about the leverage. Starbucks can use your prepaid money to open new stores, renovate old ones, or invest in new products, all without borrowing a cent from a real bank. They are essentially funding their own expansion with their customers' money, for free. It is a financial perpetual motion machine. But here is the catch. Unlike a real bank where you can withdraw your money at an ATM, Starbucks creates a lock-in. Once you convert your dollars into their digital ecosystem, you can never get them back as cash. It is a one-way street. That money is now trapped, valid only for one thing: coffee. They have effectively printed their own currency that is only accepted within their borders. Getting an interest-free loan from customers is brilliant, but it gets even better. There is a dirty little secret in the gift card industry that generates hundreds of millions in pure profit for doing absolutely nothing. It is an accounting term called breakage, and this is where the Bank of Starbucks truly prints free money. So, what is breakage? It's the money you forget. The $2.50 left on a gift card you lost. The app balance you never used. In the accounting world, if a gift card isn't redeemed after a certain period, the company can eventually recognize that liability as profit. They didn't sell you a coffee, they sold you nothing and kept the cash. You might think this is just pocket change. You would be wrong. In 2021 alone, Starbucks reported over $160 million in breakage revenue. That is $160 million of pure profit with zero cost of goods sold. That covers the operating costs of hundreds of stores without brewing a single bean. It is also a tax loophole dream. When you buy a gift card, Starbucks gets the cash instantly, but they don't have to recognize the revenue or pay tax on that revenue until you actually buy the coffee. They get the liquidity today, but the tax bill comes tomorrow. It is the ultimate cash flow advantage. So, let's recap the mechanism. They take your cash interest-free. They lock it in so you can't withdraw it. They invest it for their own expansion. And if you forget to use it, they keep it as free profit. Starbucks isn't just a coffee chain. It is a brilliant, unregulated hedge fund that uses sugar water to fund its portfolio. On paper, this looks like the perfect business model, but there is a massive problem. This obsession with financial efficiency and high-speed transactions is beginning to destroy the very soul of the company. The bank is killing the brand. And the people suffering the most aren't the customers, it's the employees. The mobile app was designed to hold money, but it also flooded stores with complex, customized mobile orders. Baristas are no longer connecting with humans. They are essentially working on a factory assembly line, frantically trying to fulfill orders from an algorithm. The romance of coffee is dead, replaced by speed. Starbucks became famous by being the third place, a cozy spot between work and home. But to maximize the financial efficiency of their app, they are pivoting to pick-up-only stores. They are removing the chairs. They are removing the bathrooms. They are turning cafes into vending machines to serve the digital bank ledger. And finally, consider the risk. Since Starbucks operates like a bank but isn't regulated like one, what happens in a crisis? If everyone decided to redeem their stars and balances on the same day, a coffee bank run, Starbucks would face a logistical collapse. They owe more coffee than they can physically brew in a year. This immense power hasn't gone unnoticed. Governments and financial regulators are starting to ask uncomfortable questions. If it walks like a bank and holds money like a bank, shouldn't it be regulated like a bank? Starbucks is currently operating in a gray area, a shadow bank, but legislation is catching up. The era of completely unregulated freedom might be coming to an end. And they aren't alone anymore. The secret is out. Competitors like Dunkin', Panera, and McDonald's have realized the power of the app-based float. They are launching their own aggressive rewards programs, eating away at Starbucks' dominance. The digital moat that Starbucks built is drying up as everyone else copies their homework. This leads to the success trap. Starbucks became so addicted to the easy money from financial engineering and high-speed throughput that they arguably lost focus on their core product, the coffee itself. When you prioritize speed and app engagement over the craft of brewing, you risk alienating the very customers who built your brand in the first place. We are seeing the cracks form right now, from massive unionization efforts by overworked staff to complaints about rising prices and declining quality. The hyper-efficient financial machine is colliding with the messy reality of human service. They optimized the money, but they forgot the people. So, let's step back and analyze what this really means. The $1.6 billion in float is impressive. But the real treasure isn't the cash, it's the data. Starbucks knows exactly what you drank, where you are, and even how to manipulate your behavior with a push notification. In the modern economy, data is more valuable than interest rates. Starbucks is the blueprint for the future of retail. We are entering the era of embedded finance, where every major tech company and retailer wants to be your bank. Apple, Uber, Amazon, they are all following the Starbucks model. They don't just want your purchase, they want to hold your wallet. However, the lesson here is a warning. You can automate payments, but you cannot automate hospitality. Starbucks proves that you can build a financial empire on coffee, but if you strip away the human connection that makes a coffee shop special, you are just left with a very expensive vending machine. Ultimately, Starbucks teaches us that the greatest business innovations often have nothing to do with the product itself. They didn't invent better coffee, they invented a better business model. They turned a simple transaction into a financial instrument. That is the difference between a shopkeeper and an empire. So, the next time you open that green app to reload $20, just remember, you aren't just buying a latte. You are depositing your hard-earned cash into one of the world's largest unregulated banks. And the only interest you're going to get is a caffeine buzz. But Starbucks isn't the only food giant hiding a massive secret. If you think a coffee bank is crazy, wait until you hear how McDonald's makes almost zero profit from selling burgers. They are actually a real estate hedge fund. Click this video to find out how. I'll see you there.